Welcome to XRP Financial Horizon. I want to start today with something that most channels won't say out loud. A former Goldman Sachs analyst just put a $1,000 price target on XRP, and the market actually moved the same week he said it. Now, whether that's coincidence or confirmation, that's exactly what we're going to find out together today. Monday was a big day for XRP holders. The token jumped 9.3% and hit an intraday high of $1.29. That's not the kind of move you scroll past. And what made it more interesting wasn't just the number, it was the timing. It happened right as broader altcoin markets were recovering, right as geopolitical tension between the US and Iran eased, and right as on-chain data was quietly showing that the largest XRP wallets had been stacking tokens for months. When that many things line up at once, it's worth paying attention. Here's something that actually surprised me when I looked at the data. Just before this rally hit, market sentiment around XRP had fallen to its lowest point since October 2025. According to analytics firm Sentiment, investor interest was about as cold as it had been in nearly a year. But here's the thing about XRP specifically. Some of its sharpest price rallies in history didn't happen when everyone was excited. They happened exactly when everyone had checked out. Sentiment was at rock bottom, and then the price turned around and ran. That pattern showed up again this week, almost on cue. The macro trigger this time was the US-Iran deal. That single development shifted the mood across global risk assets almost immediately. Bitcoin climbed towards $65,300, oil dropped more than 3%, gold added close to 2%, and XRP caught that momentum and held it. The next day it was still trading at $1.22, up another 3.25% on the day. That kind of follow-through matters. One-day pumps in crypto are common. What's less common is when the price holds and keeps building. That staying power tells you something real is happening underneath the surface. What's underneath the surface, specifically, is whale behavior, and the numbers here are striking. Wallets holding at least 1 million XRP now control 74.1% of the total supply. And over the past 6 months, those same wallets have added roughly 1.53 billion tokens. Let that sink in. While everyday investors were losing confidence and sentiment was hitting multi-month lows, the biggest and most well-capitalized participants in this market were buying, consistently, quietly, at scale. That gap between what retail sentiment was saying and what large holders were actually doing is one of the most telling signals you'll find in any market. Sentiment captured it well. They pointed out that Ripple's institutional payment network has been expanding, and that tokenization projects on the XRP Ledger have been picking up pace, both of which have helped keep long-term confidence intact even when prices were struggling. Their key observation was this: when macro conditions start improving and whale accumulation is already in place, recoveries like the one we just saw tend to happen fast. And that's exactly what played out. The conditions were set up for weeks, the macro trigger arrived, and XRP moved. Now let's get into the $1,000 call, because this is where things get genuinely interesting. And I want to be careful here to give you the full picture, not just the headline. Dom Kwok is the co-founder of EasyA, a blockchain education platform, and before that he spent time as an analyst at Goldman Sachs. That background matters because it means he's not just a crypto enthusiast throwing out a number for attention. He's someone who understands how institutional money thinks, how markets price in future utility, and what it actually takes for an asset to generate long-term value. His $1,000 target for XRP by 2030 is built on a specific thesis, and it's worth walking through it properly. Kwok's starting point is a comparison to the early internet. He argues that the internet didn't reach mass adoption the moment it was built. It got there only after real applications emerged that people actually needed. Email, e-commerce, search. Those use cases drove adoption, and adoption drove value. He sees blockchain technology at a similar stage right now. The infrastructure is there. What's still developing is the layer of applications that will make these networks essential to daily financial life, not just for crypto-native users, but for institutions, businesses, and eventually ordinary people who may not even realize they're using a blockchain at all. Where Kwok's argument gets specifically bullish on XRP is in how he explains value flow on a blockchain network. He says that as applications get built on the XRP Ledger, those use cases create demand for the network, and that demand flows back to the token. He made this point directly. Once those applications are built out and different use cases come to the blockchain, it filters down, and ultimately, it filters down to XRP itself. That's a clean, logical path from real-world utility to token price appreciation. It's the same mechanism that drove ETH higher as Ethereum became the default layer for DeFi and NFTs. The question is whether XRP can replicate that dynamic with its own growing ecosystem. Kwok also draws a clear distinction between XRP and Bitcoin when it comes to utility. In his view, Bitcoin functions primarily as a store of value. People hold it, they trade it, but there isn't a layer of active financial use cases being built on top of it in the same way. XRP, by contrast, was purpose-built for fast, low-cost cross-border transactions. That's not a feature that was added later, it's the original design. And as Ripple's payment network grows, and as more institutions explore the XRP Ledger for tokenization
Coin headlines
settlement,
last Monday.
that built-in
XRP quietly moved 8% in a single day, not because of a tweet, not because of hype, but because two separate real-world events hit at the exact same time, and the market reacted exactly the way it should when fundamentals actually line up. One of those events happened on the other side of the world in Tokyo. The other happened in a diplomatic room that most people weren't even paying attention to. And when you put them both together, what you're looking at is not just a price move. You're looking at a shift in how governments and institutions are starting to treat XRP as a serious financial asset. So let's slow this down and talk about what actually happened, because the details here matter more than the headline number. Japan's lower house of parliament passed a bill last week that most Western crypto media barely covered, and that is honestly a shame because it is one of the most significant regulatory developments XRP has seen in years. The bill brings major cryptocurrencies, XRP included, under Japan's Financial Instruments and Exchange Act. That's the same legal framework that governs stocks and bonds in one of the world's most financially sophisticated economies. What this means in plain language is that Japan is no longer treating XRP like a gray area digital asset sitting in some undefined legal corner. The government looked at it, evaluated it, and decided it belongs alongside recognized financial instruments. That kind of formal legal recognition from a G7 nation carries real weight, and anyone who tells you otherwise doesn't fully appreciate how cautious and methodical Japanese financial regulators tend to be. This didn't happen overnight. This was deliberate. The tax piece of this legislation might actually be even more impactful in practical terms than the regulatory classification itself. Before this bill, Japan had a top capital gains tax rate on crypto profits of 55%. That number is not a typo. 55%. Imagine making a solid return on your XRP position and then watching more than half of it disappear before it even hits your bank account. That kind of tax environment doesn't just discourage casual investing, it actively pushes serious capital away. Institutional allocators in Japan have been looking at that rate and choosing to deploy their money elsewhere. Retail investors who might have gotten involved years ago stayed on the sidelines because the math simply didn't work in their favor. The new legislation replaces that punishing rate with a flat 20% capital gains tax, which is the same rate applied to Japanese stock market investments. That single change flips the entire investment equation for Japanese participants. Think about what that actually means in terms of capital that could now start moving. Japan has a large, educated, financially active population with genuine savings and investment habits. The crypto market there already has meaningful retail participation, despite the hostile tax environment. Now that the tax rate drops to something comparable to equities, and now that XRP carries official recognition as a financial instrument under Japanese law, you remove two of the biggest friction points that were keeping money on the sidelines. Analysts following the Japanese market are saying this combination could unlock a wave of both retail and institutional participation that was simply not possible under the old rules. And XRP, with its deep existing ties to Japanese financial institutions and payment networks, is well positioned to benefit from that wave more than most other digital assets. While all of this was developing on the regulatory front, the broader